Welcome back. In this video, we are going to talk about determining free cash flow and NPV. And NPV stands for net present value. In our previous video, we have discussed how to forecast your earnings. And as said, this video, we're going to go from earnings to cash flow and also how to calculate the NPV to make the investment decision. In video 3 that follows, we're going to analyze the project, and in the last video I'm going to give you a summary. In a previous video we talked about forecasting earnings, and we said that forecasting earnings is the first step to calculate the underlying cash flow, and from cash flow we go to NPV. Now, why cash flow? Because cash flow actually measures the incremental effect of a project on a firm's available cash. So in other words, the free cash flow has an impact on the available cash position of a company. Let's look at how we can calculate the free operating cash flow. What we can see from this equation is that the first step into calculating the cash flow is the NOPLAT. And the NOPLAT from the previous video can be calculated as revenues minus cost/expenses minus depreciation. This would give you the EBIT, earnings before interest and taxes. From the EBIT we need to deduct our taxes, and then we get the NOPLAT. Okay, so this is like the first step into calculating our cash flow. Now, from NOPLAT, we actually need to add the depreciation expense, because depreciation is not really a cash outflow. So in other words, we need to add it up. Then we need to deduct our Capex, which stands for capital expenditures in our fixed assets. And then we need to deduct our investments in our net working capital position. Let's go back to what I said about depreciation and Capex. Depreciation is considered a non-cash expense, so that means that the free cash flow should be adjusted for this non-cash expense. So in other words, we need to add depreciation to the NOPLAT. Capital expenditures are the actual cash outflows when an asset is purchased. These cash outflows are included in calculating free cash flow. So in other words, if we have a Capex, so we're going to buy a fixed asset, we need to take it out of our cash flow. In other words, we need to deduct the investment from the cash flow. Let's go from NOPLAT to cash flow. This is a new table, but maybe not that new, because I think you recognize the first part of it. This is the NOPLAT calculation, as you can see, from sales to NOPLAT for year 0, 1, 2, 3, 4, and 5. So this part over here actually comes from our NOPLAT calculation in the previous video. So if you need some extra assistance in how to calculate NOPLAT, my suggestion is to please have a look at the previous video. Okay, so we've established a NOPLAT for year 0 until 5, and now we need to go from NOPLAT to cash flow. The first line that we're looking at is called depreciation. And as said in a previous slide, the depreciation should be added to the NOPLAT, which you can see over here. We have 1, 2, 3, 4, 5 years of depreciation, so 1.5 million is added to the NOPLAT for year 1, for year 2, 3, 4, and 5. The next line is called Capex, capital expenditures. And here you can see that this is an investment of 7.5 million. I remember from the first video that this was the 7.5 million investment in the equipment. So in other words, it's going to be taken out of our cash flow, so therefore we need to deduct 7.5 million from our NOPLAT. And then in the last row you can see increase in net working capital, and here you can see a investment of 2.1 million in year 1 and here a disinvestment of 2.1 million in year 5. So here we need to deduct it from our NOPLAT, and here we need to add it up. Now, in the next slide, I'm going to explain in a little bit more detail how we get to 2.1 million negative and how we get to 2.1 million positive. Let's have a look at our net working capital. Most projects will require an investment in net working capital. Remember from the video about financial statement analysis that net working capital can be defined as current assets less current liabilities. And current assets can be broken down into cash, inventory, and receivables. And current liabilities is related to the payables. So in other words, if you have cash plus inventory plus receivables less payables, you have calculated yourself the net working capital. And to make it a little bit more simple, if the net working capital only would have consisted of receivables and payables, so no cash and no inventory, then receivables less payables is called trade credit. So in other words, your net working capital would be equal to trade credit in the situation when you have no cash and inventory. Let's have a look at how net working capital ends up in our cash flow calculation. What we can see here is that the delta net working capital at time t is the net working capital at time t less the net working capital a year earlier. Okay, how does that work? For example, we have a net working capital position at the end of year 1 of 100. Okay? We had a net working capital at the start of the year of 50. So 100 less 50 is 50. Now, because the 50 is a plus, we need to deduct it from our NOPLAT because we consider a plus net working capital a investment. Okay, now let's have a look at a different situation. Let's assume that the net working capital at time t is not 100 but is 200. Okay, the net working capital position at t minus 1 is actually 400. So we have 200 at time t, we had 400 a year earlier, so this means that the delta is going to be minus 200, which means that minus 200 should be added to your NOPLAT because we consider it to be a disinvestment. If you're looking for a more simple approach as to why you need to add or deduct your working capital from your NOPLAT, let's have a look at the more simple approach. Let's assume that at the end of the year, you have an inventory position that is larger than your inventory position that you started the year with. In other words, you have spent money on inventory. In that case, you need to take it out of your cash flow. You need to deduct that from your cash flow. Vice versa, if you have an inventory position that at the end of the year is smaller than your inventory position that you started the year with, you actually have sold inventory and you need to add it to your cash flow. So how does the working capital looks like? We have in year 1 50% of sales as receivables and 50% of cost of goods sold as payables. So we have a working capital position of the receivables less payables is of course the working capital, 2,100,000. In year 2, 3, and 4 we have the same level of working capital. Now, in terms of investment and disinvestment in working capital, we have to deduct the net working capital in T1 less the working capital position in T0. Well, in T0 we had nothing. In T1 we had a working capital of 2,100,000. So this is considered an investment. In other words, the 2,100,000 needs to be deducted from your cash flow because this is considered an investment compared to T0. Here we have no investment because the level of working capital in year 2 is exactly the same as year 1, so the delta here is 0. The delta here as well is 0. Here also 0, so no investment here as well. However, in year 5, you're going to divest your working capital, you see, because you go from 2,100,000 to 0. So that means that in year 5, we actually have a disinvestment in net working capital, which will generate you a cash inflow of 2,100,000. So in a nutshell, in year 1, we have a negative cash outflow of 2,100,000 in terms of working capital investment. And in year 5, we have a disinvestment. And here we need to add 2.1 million to the cash flow. In sum, we have calculated the NOPLAT, and we went from NOPLAT to free cash flow. And the next step is that we need to calculate the NPV, which stands for net present value. The net present value of the project is the present value of all cash flows less the present value of the investment. Okay? The equation to calculate the present value of all the cash flows is the cash flow divided by 1 plus R, and R stands for the cost of capital. So in other words, the cost of capital for space agency related to the spacecraft project is 12%. So to go from free cash flow divided by 1 plus R, we need to identify all the relevant cash flows, and we need to divide the cash flows by the cost of capital. Now, another way of calculating the present value of all the cash flows is by multiplying the cash flow at time t times 1 minus 1 plus the cost of capital to the power t. So in other words, if the cash flow, for example, in year 1 is going to be 100, we need to multiply that by 1 divided by 1 plus the cost of capital of 12% to the power 1. If the cash flow in year, 2 would be 200, then the cash flow at time t, that would be year 2, is 200 times 1 divided by 1 plus 12% to the power 2. So that's how we are going to calculate the present value of all the future cash flows. And remember that in the end, we need to compare the present value of all the cash flows with the present value of the investment. Is the present value of all cash flows larger than the investment? Then we would have a positive NPV, and it is a go. Is the present value of all the future cash flows lower than the present value of the investment? Then we would have a no-go because the cash inflows are simply smaller than the investment. So in sum, we have two ways of calculating the present value of the cash flows. This is the first method, and this is going to be the second method. In the slide after this one, I have calculated the NPV using this method. Okay? Here I have made a table which shows you the cash flow per year, 0, 1, 2, 3, 4, and 5. And the cash flow from the previous exercise is 16.5 million negative at T0, so at the start of the project. 5.1 million, 7.2, 7.2, 7.2, and 2.7. In this row, I have added the discount factors. If you want to know how to calculate the discount factors, my suggestion is to go back to the previous slide in which I've shown you how to calculate these factors. In any case, in T0, the cash flow is going to be 16.5 million negative, and we're going to multiply that with 1. Because the present value of the investment, of course, is already 16.5 million. The cash flow in year 1 is 5.1 million. The present value of that is 4.5 million. So in other words, the equivalent value today of cash flow in year 1 is going to be 4.554 million. And let's have a look at the last one. In year 5, we have a cash flow of 2.7. but the equivalent present value of that particular cash flow is going to be 1.532 million. Now, what we're going to do is the 4.5, the 5.7, the 5.1, the 4.5, and the 1.5, if we're going to make the sum of all of this, we will get the present value of all cash flows, okay? So we need to make sure that the sum of the first 5 cash flows, or the sum of the present value of the first 5 cash flows, is larger than the 16.5 million. Well, in the NPV presentation over here, you can see that I've put in here the investment, and here all the present value of the future cash flows. And in sum, what we're going to get is like a 5 million positive NPV. So in other words, clearly the present value of all future cash flows is larger than the present value of the investment. So according to the NPV decision rule, it would mean that we need to go ahead with the project because it actually adds value to the firm. So in sum, we can argue that launching the spacecraft project produces a positive NPV, which we've seen in a previous slide, while not launching the project produces a 0 NPV. So in other words, if you don't do anything, of course, you would not add anything to the value of the firm. In real life, obviously, you also need to evaluate alternatives. And based on the alternatives, based on the underlying NPVs, you need to make a decision which project gets funded and which one do not. Looking at some of the practicalities about calculating cash flows, what we can see is that the timing of cash flows is very important. So in our case, we have a investment at T0, and we consider all the other cash flows to be generated at the end of the year. Now, of course, cash flows can also be spread throughout the year, but that's something that we have not taken into account in our model. We simply assume that we have the cash flows either at the start of the year or at the end of the year. Besides the timing of cash flows, we also assumed a very simplified approach towards the depreciation scheme. But of course, you need to understand that there are many other depreciation schemes. And of course, it also has an impact on the size of your cash flow if you're going to change your depreciation scheme. For example, we can also accelerate the depreciation using the modified accelerated cost recovery system. I won't go into detail about this particular system. I think the only thing that matters is that you understand that in our case, we have a very simplified approach towards adding depreciation in our financial model. But in real life, you can sometimes have more complicated depreciation schemes that will impact your cash flow. What we also need to include in our financial model is the situation when we can sell the underlying asset at the end of the lifetime. For example, if we have at the end of the lifetime a book value of the underlying asset of 400 and we can sell it for 500, then we have a capital gain of 100. Well, what we need to understand is that we need to pay taxes over the capital gain. So that means that our after-tax cash flow from asset sale is nothing more than what we get from the market in terms of sale price, 500, less the taxes that we need to pay over the capital gain. Let's have a look at the after-tax cash flow from asset sale in some more detail using our spacecraft example. Let's have a look at self-test number 1. Suppose that in addition to the 7.5 million in new equipment required for spacecraft, we have new equipment which is transferred to the lab from another facility. This new equipment has a resale value of 2 million and a book value of 1 million at T0. If the new equipment is kept rather than sold, so in other words, we also have the opportunity to sell it, but we are not going to do that, we're going to use it for spacecraft, the remaining book value of 1 million can be depreciated at T1. When the lab is shut down in year 5, so the complete lab, including the new equipment, is shut down in year 5, the new equipment will have a salvage value of 800,000 euro. The question is, what adjustments must we make to spacecraft's free cash flow in this case? Let's look at the answers of self-test number 1. So the equipment that spacecraft received from another facility could have been sold for 2 million euros, but we didn't because we obviously going to use it for spacecraft. Now, the after-tax proceeds from this supposed sale is actually an opportunity cost of using the equipment in spacecraft. So we must reduce spacecraft's free cash flow in year 0 by 2 million euros less the taxes that we needed to pay. So in other words, 1.6 million is considered an opportunity cost for spacecraft because space agency also could have gotten 1.6 million in cash flow, but of course it didn't because it used the facility for spacecraft. Therefore, spacecraft's financial model should include 1.6 million in year 0 as a cash outflow. At the end of the first year, we have an additional cash inflow of 400,000 euros, which we call depreciation tax shield. Now, how does this work, the 400,000? That is the 1 million of extra depreciation expense that we can include in year 1, and the 1 million extra expense will lead to a tax benefit or tax shield of 400,000, which is 40% times 1 million. So in other words, the 400,000 is nothing more than an additional tax benefit measured in cash flow. At the end of the lifetime, we can actually sell the new equipment for 800,000 euros. And after tax, that will be an additional cash flow of 480,000 euros. So now we need to recalculate the cash flows, including the new equipment. And we can see that in year 0, we have a cash flow of 18,100,000. In year 1, we also have a different cash flow compared to the previous example. In this case, we have 5.5 million. And compared to the previous example, we have a new cash flow in year 5 as well of 3,180,000. Now, the NPV, the new NPV with equipment is going to be 4,055,000. That means that the present value of all these cash flows are higher than the present value of the investment. So in other words, we have a positive NPV. The interesting question here is, would space agency be better off selling the new equipment in the market or using it for spacecraft? The answer can be found in the comparison of the NPVs, because the NPV using the new equipment is 4,055,000, but the NPV without using the new equipment is going to be 5,027,000. So in other words, using the new equipment for spacecraft is actually reducing the value of the firm, and therefore space agency would be better off selling the new equipment in the market. The last adjustments to free cash flow that we're going to discuss is called terminal or continuation value. Now, in our spacecraft example, we have seen that the underlying asset has a limited economic life of 4 years, which actually means that after year 4, the spacecraft is not producing any cash flow. Now, in some cases, we can actually see that the underlying asset is going to produce a cash flow until the infinity. So in other words, that the underlying cash flow does not cease to exist. In the next example, which we are going to discuss on the next slide, we are going to have a little bit more detail about how to exactly measure the terminal or continuation value. So in self-test number 2, we are going to have a look at a case where we need to compute a terminal value. So that also means that the underlying asset is producing a cash flow until the infinity. instead of producing a cash flow with a limited economic life. The case goes as follows. Space Agency is considering to sell a new product called Mars Landing, and this product or project has nothing to do with spacecraft. It's a separate project and it also has its own cash flow projections, which you can see over here. Mars Landing is expecting an investment of 10.5 million at T0. The expected free cash flow is 5.5 million negative in year 1, and year 2, 3, and 4 they're going to expect a positive cash inflow. Now, after year 4, so year 5, 6, and onwards, Mars Landing is going to expect the free cash flow to increase at the rate of 5% per year. Looking at the growth rate of 5%, we can see in the timeline that the cash flow in year 5 is actually the same as in year 4. However, the difference is that we here multiply the cash flow with 5%. In other words, we're going to add the growth of 1 year to the cash flow of year 4. In year 6, the same thing. Here also we take the cash flow in year 4, but we add the growth rate related to 1 and 2 years. So in other words, in year 6 we have a cash flow which is equivalent to the 1.3 in year 4 times 1.05 to the power 2 years of growth. Furthermore, this project Mars Landing has an infinity time window, which means that the underlying cash flow is not limited to 6 years, but the underlying asset is also producing a cash flow until the infinity. So it is not limited to 6 years, but the asset will produce a cash flow forever. Let's discuss the two questions. The first question is, if the appropriate cost of capital for a Mars Landing is 10%, what is then the terminal value in year 3 that captures all the cash flows in year 4 and onwards? Okay, so the question is, what is the terminal value in year 3, which is a value equivalent to all the cash flows in year 4 and until the infinity. Question 2 is, what is the NPV of Mars Landing at T0? Okay. In this slide, I have included the answers to the two questions, terminal value in year 3 and the NPV at T0. Let's first start with the terminal value. Okay, so the expected free cash flow from the Mars Landing in year 4 is 1.3 million. It also means that the future cash flows beyond year 4, so in year 4 and onwards, are expected to grow at 5% per year. Now, if we need to calculate the present value of all cash flows in year 4 onwards, we can actually use what we call the terminal value equation. This equation is well established in the finance literature, and it works as follows. The cash flow in year 4 is going to be 1.3 million. The R is the cost of capital at 10%, and the G is the growth rate at 5. So in other words, if you fill in these numbers in the equation, the answer is 26 million. But what does this mean, this 26 million? The 26 million is nothing more than the present value of all future cash flows in year 4 and onwards. So in other words, the 26 million at T3 represents the present value of all the cash flows that the Mars Landing is going to produce in year 4 and onwards. Let's try and answer our second question, and that is, what is the NPV of Mars Landing at T0? Now, in order to calculate the NPV, we need to calculate the cash flows in year 0, 1, 2, and 3. In year 0, we have a negative cash flow of 10.5 million, which most likely is due to a very heavy investment. In year 1, we have a negative expected cash flow of 5.5 million negative. In year 2, we have a positive one of 800,000. In year 3, we also have a cash flow coming in of 1.2 million. But we also need to include the 26 million of terminal value at T3. And remember that the 26 million represents the present value of all future cash flows in year 4 and onwards. So the NPV looks like 10.5 million negative, which is the initial investment. Then we include the negative cash flow in year 1, and we're going to divide that by 1.10 to the power 1, because it's 1 year back. Then we have the 800 over here that we're going to discount by 1.10 to the power 2, 1, 2. And then the third cash flow is 27.2 million, and that value we're going to discount 1, 2, 3 years back. So we get 27.2 million divided by 1.10 to the power 3. All together, we will have an NPV of 5.597 million. So in other words, the present value of all cash flows is larger than the initial investment, and therefore we would have a positive NPV, and that means that we would need to say a go to the project Mars landing. So this is the final slide of this video. We have discussed how to calculate cash flow using NOPLAT and Capex and investments in net working capital. And we also have discounted cash flows in order for us to calculate the NPV of the underlying project. In the next video called Analyzing the Project, we are going to look at some kind of sensitivity analysis, and we will discuss if you change some of the items in the cash flow, how that would change the NPV. So my suggestion is to please open the next video. Thank you.